Matthew, it's great to see you again. Welcome to another edition of Gold Matters. I don't think we could be speaking at a more interesting time for precious metals, given crazy events going on in the world at the moment. Um, so let's get straight to it. I want to ask you what a lot of people have been asking me recently, and that is that in the face of this severe crisis in the Middle East, why is it that precious metals have been behaving as poorly, as weakly as they have been over the last 6 weeks or so?
Sure.
And secondly, can you just put that into context of how unusual or not that it is that gold can sell off at a time of what looks like a serious crisis?
Yeah, Johnny, these are the questions du jour right now, and they're totally appropriate. And it's very, very normal to be reactive or have questions. I mean, especially now in this geopolitical inflationary setting and this currency crisis setting. But, the larger historical lessons and the whole von Greyerz message remains unchanged and simple. I mean, as we've talked about and written about, debt destroys debased currencies. And gold has always been and always will be a superior store of value and wealth preservation asset, especially now in this period of undeniable geopolitical risk, banking risk, currency risk, and of course, the guns and the drums of war. But this creates a lot of fog and a lot of confusion, which we need to put in perspective. And I think it's so important to use this context to put it into perspective, to your point. When you look at gold, you have to differentiate certain things. Again, there's the simple theme that we've always said. It's simply a better store of value than dying paper money. So you have to understand and keep in mind the difference between paper and physical gold. You have to keep in mind the difference between short-term speculators and long-term wealth preservation investors in gold. And I think what we're seeing now in this fog of war and this inflationary setting from the oil or risk asset repricing is really a sell-off in paper gold. It's the worst in over 40 years, since 1983, so we can't deny it, but it's actually not that unusual. And to explain it, I think the official narrative actually, in some ways, does make sense. When inflation is going up or yields are going up, Fed rates are rising, it's usually very good for the dollar. It's usually short-term very bad for gold. And we saw this before, not that long ago, when rates went up under Powell in 2018, or certainly more recently, in 2022 and 2023. Under Powell's higher for longer to fight inflation, rates were up, yields were up, dollar was up, and everything else was bad. But we have to keep in mind, what did gold do after 2023? What did it do into 2024 and the exponential rises in 2025? It's history repeating itself, or certainly rhyming, and we're in that phase right now. In the current environment of 39 trillion in the debt corner, really, of 39 trillion in public debt in the US, higher rates from higher inflation just mean higher debt costs, which just means more money printing and more inflation and more currency debasement. So then gold rips. It will rip again, as it did in 24 and 25. So in my mind, what we're seeing right now is a fantastic buy signal or buy opportunity. And there are other factors, of course, Johnny. I mean, look, we saw massive inflows into ETFs last year, 70 billion into gold ETFs. A lot of those were not wealth preservation thinkers. They were speculators, tourists in the gold space. And a lot of that ETF purchasing was in ETFs that were 2 to 3 times levered. So again, not long-term preservation thinking. When the signals came that gold was trending down, they sold. And when they sold at 2 to 3 times leverage, the margin calls caused a massive sell-off in the price. You could also look at hedge funds and their algos. Again, these are not wealth preservationists, long-term thinking actors. They're dumping on algo signals. And you have to also keep in mind that in a gold bull market, like we saw between 71 and 1980, there was a major sell-off mid-year through that cycle, a major sell-off in 75 and 76. So it's not uncommon to shake out the minnows, so to speak, so the whales can accumulate physical gold. But I think one of the most interesting things that is not at all unique and nothing new to history is that what I call the dumping of the good, Johnny. When rates are rising, whether that's from inflation or re-risking or repricing bad debt, it kills everything but the dollar in this uber-levered kind of debt-driven financial system that we're in. So when credit markets start to tank, as we've seen in private equity or private credit, et cetera, as the cost of debt spikes, stock market risk increases as well, because a lot of those stocks are driven by debt. I think people forget that the S&P 500 The top 10 names in the S&P 500 have more cash than the bottom 400 stocks combined. So in this stressed out scenario in credits and equities or stocks and bonds, it really creates a paradox where the good is sacrificed for the bad. Investors, that is, must sell the most liquid and valuable assets. And so the better the asset is, the more brutally it's sold off. That's certainly true of gold, but just to keep this agnostic, it's also true of investment grade credits. What we're seeing right now is that the markets and investors are dumping their most valuable and liquid material, like gold, but they're also dumping investment grade stocks. So we see this irony where great bonds, triple B bonds like at Boeing or AT&T or Verizon or Oracle, are being sold while junk bonds can't find a market. And so junk bonds are actually more valuable than investment grade right now. So it's this kind of selling of the good in a period of craziness. And I want to kind of close.
Sort of you sell what you can, not
Exactly.
necessarily what you want to. You sell what's
Exactly.
most liquid and what you can, yeah?
Exactly. And this is nothing
And we
new.
saw
We've
it in
seen
2008. We saw it in
ex-
2008, right? It
actually,
was,
absolutely. Gold was very sympathetic with falling markets
yeah,
for a very short time, and then it
yeah,
found all-time new surges. I think we're
yeah.
setting up for that right now. Again, this is why gold is a great buying opportunity right now. And I don't think we need to be this as apologists or even, you don't even need sensationalism to put this in perspective. There's a lot of legitimate concern right now about AI robots taking all our jobs, or the entire private credit system collapsing, or we could have Weimar-like hyperinflation to create a contagion effect. But ironically, Johnny, we don't need a major implosion to create a major implosion. And I just want to close with a couple reminders that we all remember the subprime mortgage crisis in 2008. And at that period, we have to keep in mind that only 13% of US mortgages were considered subprime. And of those, only about a quarter of them were actually defaulting. So in the whole great financial crisis led by mortgage-backed securities and defaulting mortgages, in the US, we only had 5% of our mortgages actually default. But 5% was enough to create a global financial crisis. And I think that's important when you think about AI too. We don't need everyone's job to be lost to AI this month or this quarter or this year. All we need is to get to 6% unemployment, which we're very close to. That's enough to create a major crisis. So in short, it's a very, very fragile system. And when it breaks, that fragility spreads. And gold, which is liquid and valuable, can be a momentary victim, as we've seen in the past. But like a cannon backing up before it fires forward and goes much higher. So again, this is a buying opportunity, not an apology for gold. For those who understand gold, as we do, as a wealth preservation, long-term legacy asset, this is a great opportunity. But I know, Johnny, you have a lot of interesting and some kind of compelling data to kind of keep these macro thoughts into perspective. So I'd like to kind of get your thoughts on
Yeah.
the numbers you're looking at.
Well, you know me, Matt. I like. There's nothing better than a few stats or numbers to sort of put the crisis into perspective and to put gold into perspective. Because, you
Yeah.
know, I often get asked, how do you actually value gold, right? I can value a bond or I can value a stock, but how do I actually value gold? And so,
Right.
you know, I've got some metrics that I do want to talk about. But before I get into just a couple of simple numbers, it does strike me as extraordinary is that whatever happens in the Middle East, inflation is going to be,
Yep.
you know, very, very high in the second half of this year. The inflationary shock that is coming, I think, will surprise a lot of people, certainly the consumer. And
Yep.
so, whilst Trump talks about unleashing hell on the Middle East or on Iran, sorry,
Yeah.
he's unleashing a stagflationary environment that we haven't seen since the 70s.
Yep.
Because let's just focus on facts. The facts today is that inflation is going to be higher and growth is going to be lower.
Mm-hmm.
And so, you know, I was amazed when I read the other day that already the oil supply shock is 3 times bigger than the 1973 Arab oil embargo.
Yep.
But in 1973, if you compare the US then to the US today, in 1973, debt to GDP was 32%.
Yeah.
Well,
Unbelievable.
today, it's 122%. You talk about fragility.
Yeah.
And in 1973, the US fiscal deficit was 1%,
Yeah.
whereas today, what is it, 6, 7%. So
Yeah.
we're so indebted at a point where we cannot afford those higher rates. So Now we're
Hmm.
seeing bond yields ticking up, right? Government bond yields. We're seeing stress in the private credit markets with BlackRock, Blackstone, JP Morgan, Carlyle, Apollo, you name it, the great and the good, all
Hmm.
gating funds because they're being overwhelmed with redemptions.
Right.
And yet we find ourselves at a time where the gold price is going down just at the point where the fundamentals are clearly getting stronger.
Hmm.
It's really amazing. And for those that, can take long-term views, which we do at Von Greyerz, wealth preservation for our clients, it's a fantastic opportunity because what's coming? It's printing of money and it's yield curve control. Because if these sovereign bond markets break, we know what the governments will do. They'll print money to save the bond markets, to keep yields down at
Hmm.
the expense of the currency.
Hmm.
So, just look, there are three metrics. Let's
Hmm.
value gold relative to federal debt, US federal debt, and let's value gold relative to foreign held US debt. And when we look at the price of gold today, the value of gold today versus stock markets, you've got the long-term average, right? Gold as a percentage of stock markets over the long term
Hmm.
has been 40%.
Right.
Okay, and today we're less than 20%. Okay,
Right.
so just taking a long-term average, you get to a value of gold of $10,000.
Hmm.
So then let's take the second metric. Let's look at gold reserves as a percent of federal debt. And today we're at 3%. Okay. In 1980, the last sort of great peak, it was 18%.
Hmm.
And at the end of World War II, it was even above 50%,
Right.
right? So you can see that if we just get back to the 1980 peak of gold as a percentage of US debt, right?
Yeah.
Gold should be 18%, $26,000 an ounce, Matt,
Sounds crazy. Yeah.
against 4,500 today, but just
Right.
multiples higher. And
Right.
let's take one more metric. Let's look at the value of gold as a percentage of foreign held debt
Hmm.
today. That's at 14%. And the long-term average over the last 80 years is between 40 and 60%. Let's call it 50% between friends. So there you go. You're
Right.
at between 15 and $20,000 an ounce.
Right.
So I'm sorry if I've blinded you with too many numbers there, but I do think that it's incredibly important for us to explain that when you look at the value of gold versus stock markets and debt markets and
Hmm.
foreign held debt in the US, gold is unbelievably cheap against any time in history. And
Absolutely.
at a time where the fundamentals are that strong, okay, for gold, and a time where the risks are rising, partly as a consequence of the war, but mainly just because of the debt. Debt now $39 trillion officially in the US and rising every single day that this war goes on.
Hmm.
It's really quite a gift for long-term
Well,
investors that
it
can
really
afford to
is. I
stack
mean,
gold.
it's absolutely true, Johnny. I mean, again, we start with history. At the end of the day, debt does destroy. We've known this from the 1750s to today, and there's so many examples. But history doesn't have to repeat itself exactly. The rhyming that you're talking about with the mathematical data and the fundamentals that historical cycles show, the combination of basic math and basic history makes the longer term direction of gold axiomatic and not, again, just an apology for gold executives out of Switzerland. It's very important that folks fact check the history and fact check the data that you've just shown to give them more conviction, more confidence in these kind of retracements so that they can have a longer term view and a preservationist view rather than a speculation mindset and speculation fears. There's no need to be afraid of these pullbacks if you understand the history and math of gold. And we're living in it right now. That makes it more difficult. But I think those data points you've given, and we'll put charts up to confirm them, just make it that much more easy to understand the math and the fundamentals and the history combined beautifully right now to give longer term investors in gold tremendous confidence right now in a time of of craziness in the world. I mean, gold can't solve every problem. We don't know what foreign policy or geopolitics are going to do next week, the next Twitter cycle, the next half hour. But we do know where the currencies are going, and we know where gold will follow. And with that conviction, we can have a lot more calm, at least in that part of our lives right now, Johnny.
Well, as I said, I think we're staring at the 1970s revisited, and of course when we had that stagflationary time, gold went up 28 times over that period. And as we sit here chatting today, since the lows at the start of this century, gold has gone up, 13, 14 times. So even if we were just to match the 70s, gold has to go up another 4x. So again, it's just straight maths that, again, you get to around $15,000 an ounce. But anyway, that's enough numbers. Thank you for explaining what's going on in the world at the moment. It's not straightforward, but as always, I appreciate your time, Matt, and let's do it again soon.
Always a pleasure, Johnny. Till the next gold matters. Always a pleasure. Cheers.
Bye.